In this video, we will talk about volume indicators. We have selected a top list of the most popular and possibly the most effective indicators. We'll move from simple to more advanced tools and see how all of this can be applied in your own analysis. What is the advantage of volume analysis? The key benefit is that, in addition to regular Japanese candlesticks, we can see all the information that was happening behind the scenes. We see all the buying and selling that occurred at every price level within each bar. We can identify whether buyers or sellers were dominating. With this volume data, we can build statistical scenarios for making trading decisions, both for entries and exits. Of course, there are many more volume indicators available, but in this video, we'll focus on the most popular ones. So, the first indicator we'll start with is the standard vertical volume in the SBProX platform. This indicator is called total volume, and it shows the vertical volume, the number of traded contracts on each candle. Using this indicator, we can identify volume spikes that may indicate a climax, meaning that a large amount of money is being traded at that moment. In the case of cryptocurrencies, this would be a large number of coins. In futures markets, a large number of contracts. At such moments, something important may be happening. For example, we see a large volume spike, then a pullback, and then another increase in volume that coincides with a price extreme. The next extreme again shows an increase in volume. We are not referring to the elevated volumes associated with the opening or closing of the US session. Instead, we focus on abnormal spikes like these, which often coincide with local extremes and the culmination of a particular move. So, that covers volume. The next element is delta. If volume shows the total number of traded contracts or coins, delta shows the imbalance between buyers and sellers within a given bar. Using this indicator, we can observe the aggression of one side of the market and evaluate the result of their actions. For example, in this area, we see a clear price decline accompanied by a strong negative delta, meaning aggressive market selling dominates. However, sometimes we encounter situations like this candle. We see a large number of market buys, strong positive delta, yet the candle is bearish. In this case, aggressive buying does not push the price higher. On the contrary, the result is further downward movement. In addition, when we use the candle delta indicator, we can see these kinds of wicks that show what was happening inside the bar. For example, buyers may have dominated at first, but then market sellers stepped in and the final delta value became smaller than it was at its peak. Such wicks may indicate the presence of strength from the opposite side. For instance, during an attempt to push the market lower, market buyers stepped in and prevented the price from moving further down. The same situation can occur during a pullback. We may see a significant number of market buyers, but then market sellers become active, hold the price within the range, and eventually a small downward movement follows. The price is not allowed to move higher. These kinds of delta wicks highlight that hidden opposition. Next, we have the trades flow indicator, which is essentially a standard time and sales tape. In this format, trades are displayed as circles of different sizes. The larger the traded volume, the larger the number inside the circle, and the larger the circle itself. With this indicator, we can evaluate the intensity of market buying and selling, as well as the volume being executed at market. It is a fairly basic tool, but at the same time very visual and useful for identifying real-time aggression from one side of the market. Next, we move on to the volume profile and TPO market profile indicators. These are very popular market analysis tools. The profile displays a histogram. The larger the histogram bar, the more time, in the case of TPO, or volume, in the case of volume profile, the price has spent at that level. The TPO market profile includes value areas, value area high, VAH, and value area low, VAL. These represent the price range where the instrument spent approximately 70% of its time. It also includes the point of control, POC, the longest histogram bar, representing the price level with the highest activity. Alongside this, the volume profile indicator shows the distribution of traded volume at each price level over a selected period. For example, if we build it for the US session on NASDAQ futures, we get a volume histogram for that session. This indicator also includes value area high, value area low, and the point of control, which represents the price level with the highest traded volume. These indicators can act as a kind of market map, providing strong reference levels where price is likely to react. For example, let's take the value area levels from the previous day's market profile and observe how price reacts to them on the following day. A trading day forms, the session develops, and the value area levels appear. Price moves downward, then returns to the lower part of the value area, essentially the cheap zone of the instrument, but fails to break through it. This zone represents relatively low prices for the instrument. Price cannot break above it because there isn't enough buying strength to push the asset higher. As a result, price moves downward directly from the point of control. In this case, the market profile levels, specifically the area from the value area to the point of control, POC, act as a resistance zone for the instrument. Let's look at another example. Again, we mark the boundaries of the value area and highlight the point of control. In this case, the market profile, POC, coincides with the maximum volume level of the volume profile indicator. On the following day, we see a breakout from the volume area range. Let's mark the zone from the value area high, VAH, to the point of control. Price then returns to these levels. The first reaction produces a small correction, then price dips toward the maximum volume level, reacts again, and continues moving upward. This shows that price often reacts to volume profile levels on the next trading day. If, as in this example, the instrument trades within the previous day's value area range, we can observe bounces and reactions at the boundaries of that range. Essentially, these indicators show the price levels where the instrument spent the most time and where the largest volume was traded. The lower boundary of the value area represents cheap prices for participants who traded the previous day, while the upper boundary represents expensive prices for them. That is why we can anticipate potential price reactions at these levels on the next day. Another powerful tool for identifying market balance is the Cumulative Delta indicator. In this platform, it is called Candle Cumulative Delta. This tool shows the sum of all deltas throughout the trading day. Typically, when price is moving upward, cumulative delta also trends upward. However, when there is a divergence between price and cumulative delta, for example, when price remains at approximately the same level, but cumulative delta at the second point is significantly lower than at the previous point, this situation is called exhaustion. Exhaustion indicates that aggressive participants are no longer able to push the price further in the direction of the previous move. In other words, price was moving upward, but the effort behind the move was relatively weak. After buyers encountered sellers, the market moved down. This situation is called exhaustion. There is also another type of divergence known as absorption. In this case, at the second point, price is lower than at the first point, while cumulative delta remains approximately at the same level. This indicates that buyers were putting in sufficient effort to push the price higher. We can see this from the intensity of the movement and from the fact that cumulative delta at this point is similar to the previous one. However, price is significantly lower. This tells us that those market buy orders were being absorbed by limit sell orders. Price was not allowed to move higher, and after this situation formed, we saw further downside movement. Next in our top list are cluster charts. Technically, this is not just an indicator, but a way of displaying exchange data that allows us to see how many buy and sell trades occurred at each price level, what the traded volume was, and which side had the advantage at a particular moment in time. Again, at every price level. Volume is displayed on the left side, while delta is shown on the right. If the histogram bars are red, market selling dominated. If the histogram is green, market buying dominated. By analyzing this information and evaluating the impact on price, and the result that followed, we can form probabilistic assumptions about what was happening at a given moment. Let's look at an example. We see a strong upward movement. A relatively large volume was traded. Large volumes are highlighted by filters, and we observe dominance of market buyers right at the highs of the candles. meaning there was significant aggressive buying at the top. However, this did not lead to further upward movement. Instead, after the volume formed and sellers began to dominate, as seen in the delta, price started to decline. Using clusters, delta, and volume, we can determine that at this point there was absorption of market buying. When the candle closed, it became clear that all those aggressive market purchases did not push the price higher. On the contrary, price moved lower. After the absorption of market buyers, we observe a downward move. Alongside other analytical tools, another popular instrument is cluster statistic. This indicator essentially displays volume and delta in a table format. One particularly useful feature is the delta to volume ratio, which shows what percentage of the total volume was dominated by buyers or sellers on each bar. For example, in one case, buyers dominated 10% of the total volume, in another, 27%. When we see strong pressure according to the cluster statistic indicator, especially when it does not lead to further price growth and occurs on elevated volume, we can conclude that absorption has taken place, followed by a potential price decline. As a supplementary tool, this indicator helps us evaluate each bar individually. Combined with cluster data, it becomes a powerful analytical instrument. Next in our top list is the cluster search indicator. In this example, it is displayed as squares on the chart. The indicator operates based on two parameters, volume and delta. When a large volume appears, for example, 450 contracts with a significant delta, in this case minus 200, these markers are formed on the chart. This indicates that at those specific levels, including here, there were limit buyers absorbing aggressive market selling, effectively slowing price movement in that range. In this example, price broke below certain levels, then stalled significantly in this area, and subsequently moved upward. Why is this tool convenient? Because it can be used directly on a standard candlestick chart. This allows us to identify important volume events without switching to a full cluster view. For example, after an upward movement, a pullback occurs. Then buyers attempt to push the price higher but fail. A large volume cluster with positive delta forms, meaning aggressive market buyers executed into resting limit sell orders, liquidity. As a result, price moves downward afterward. So, cluster search allows us to identify and filter meaningful volume events directly on the chart. Finally, one of the most unique volume-based tools is the clouds indicator. It helps us visualize large single trades or volume accumulations directly on the chart. In this case, we see single large trades. What does this event indicate? There was some price movement downward. Then, in a single print, someone executed 85 contracts at market, and afterward, price moved higher. This suggests that significant liquidity was absorbed, potentially triggering a reaction in the opposite direction. However, this is not the most interesting mode of the indicator. The accumulation mode is much more powerful. In accumulation mode, we can see that after a downward movement, multiple trades with very short time intervals between them are executed. After such an event, price moves upward. Later, after a range forms and then breaks out, similar events appear again. We can see what kind of market orders were executed, and after the breakout of that range, price continues moving higher. In another example, during an upward movement, a clouds event forms. After a minor push higher, price reverses and moves downward. This particular cloud does not fully play out, but in the moment we can observe that after a corrective move, aggressive market buying resumes and produces at least a local reaction. Further on, we see a downward move, then an attempt to move lower again. At this point, market sellers are absorbed. We see selling activity followed by an upward price reaction. As you can see, with proper configuration, such events can signal the culmination of a move. For example, large volume accumulations may appear right at the highs, and we can observe how price reacts to that accumulation. Or, as in this case, there is a key level about to break. A large accumulated volume forms. including a single large print of 417 contracts along with other significant trades. At the breakout of that level, the indicator highlights the event. In summary, by combining all these tools, you can build your own trading strategy, test it, and use the volume information we discussed to gain a statistical and informational advantage in the market. We hope this information was useful to you.